Shofi was mentioning these crazy prices when it comes to commodities, with the Bloomberg Spot Index now at a 9-year high. This question of the day from M Live: given the rally, how far can this commodities rally go? And I want to turn that question also in relation to inflation. What should markets be watching out for, given that this is sending headline prices higher?
Yeah, indeed, commodities are in a good space at this point in time, driven by both demand and supply factors. We know that production is still lagging demand estimates. There's been underinvestment into capex, into building capacities in commodities over the past decade or so. And at a time when, there are supply side pressures because of COVID, and then you've got a big demand impetus from the West, especially in the US, with the plans to develop the infrastructure program, and of course, higher consumption. And also, very importantly, consumption has shifted from services to goods over the past 12 months because of the pandemic, because people are staying at home. They're not consuming services as much. Now we expect this to normalize going forward over the next 12 to 24 months as we see the economies reopen because of the vaccination drive that's going on. So that should taper some demand down from commodities. On the inflation side, it's quite clear to us that commodities are a big driver of inflation. Our models indicate that inflation globally has a pretty high correlation with the behavior of commodity prices. And that's where the bad news is, that we expect inflation to go up meaningfully over the next few months. But the good news is that by the end of this year, the base effect will start receding, and therefore global inflation readings should start coming down.
Does that mean the market shouldn't be pricing in for central banks to start tightening?
Well, when you look at central bank action, I think you need to split into two halves. One is developed markets, where our sense is that most of the developed markets are going to treat the spike in inflation as transitory, unless they start seeing significant pass-through of higher commodity prices in wage inflation, which is not evident at this point in time. On the other hand, on the emerging market side of things, because the inflation baskets have a lot higher weightages to food and oil, you will see inflation spike there, causing certain central bankers to hike interest rates or maybe, start tightening at the margin. We've seen evidence of that in Russia. We've seen evidence of that in Brazil as well. Maybe some other central bankers also, recalibrate monetary policy, but not significantly, because there's still headwinds to growth coming from weak domestic consumption. So they will be conscious of that.
Binay, Sherry mentioned obviously the roller coaster gains that we've seen across the mining sector. Let's take a look at this Bloomberg TV chart, taking a look at valuations despite higher earnings estimates across mining names. Is this one area of the market where you're still finding value, given that elsewhere so much of the market remains very elevated?
Yeah, generally, when you look at sectors where the potential is high, and these are the old economy sectors, valuations have been cheap. And now you need to understand whether this condition is going to last for the next 1 or 2 years. I think the market's currently priced that today, if it's for the next 1 or 2 years. If it's longer term, next 5 years, maybe there is some more room for these stocks to rise.
Where else do you find value at the moment?
Well, value is elusive. The whole construct of very supportive monetary policy and very supportive fiscal policy means that risk premiums are very low at this point in time. There are some markets where you could get values linked to reopenings. For example, in Asia, we think local Hong Kong stocks could rally. Hong Kong currency is cheapened on real terms. Singapore could be another market. And then if you look at cyclicality, then, markets like Korea and Taiwan could continue to do well. I mean, I was saying that Taiwan's implied walls have shot up. Maybe if Taiwan undergoes a correction, then that's a market that could come back into play from a valuation standpoint as well.
Binay, hold on a second, because we have breaking news at the moment out of Japan. We are hearing from the economy minister, Yasutoshi Nishimura, speaking in Tokyo right now, saying that the virus emergency will be extended to May 31st. The expectation was that they would ease next Tuesday. They've been implemented since April 25th, but we've heard from the Tokyo governor, Yuriko Koike, as well, that they need to be extended given the rising infections. And the Japanese government also seeking to add Fukuoka and Aichi prefectures to the state of emergency as well. So we have seen now an extension to May 31st, and also 2 prefectures being added to the state of emergency. Let's go back to Binay, because it's not just Japan that's seeing the surge in infections. A country that's been doing really well, reining in the infections. Same thing with Korea. They were doing very well, but they're very behind when it comes to inoculation. So how do you reprice these risks in economies that you thought had overcome COVID-19?
Yeah, indeed. Delayed pace of vaccination or resurgence of new mutants is a big risk to markets, especially in economies where the pace of vaccination is not been up to mark. You talked about Japan, which is probably the country lagging the most. And that's the reason it's showing up in Japan's equity performance. It's really not gone anywhere this year, despite the fact that Japan has a pretty deep cyclical correlation. Cyclicality generally brings very good numbers out of Japan, but Japan has struggled a bit because of the concerns about this vaccination. And maybe, are there worries about the postponement of the Olympics? There are some concerns over there, right? Similarly, moving away from Korea, which has done very, very well, by the way, on market performance numbers. But, India is beginning to lag because of the fact that there are cases which are rising, vaccinations are going up, but at a slow speed, not good enough from a market perspective, which is causing a lot of investors to trim down their estimates for GDP growth in India from maybe like 11, 12% down to about 10, 11% now. And unless India gets a hold over the increasing pace of new cases over the next 2 or 3 weeks, you could see more downgrades, which could impact the performance for Indian assets as well.
Binay, when it comes to India, at what point do you see opportunities, right? What would you need to see when it comes to the virus situation or what the government is doing there, or perhaps the vaccination levels that would make you see that there is a confident path forward for the economy?
Yeah, to start with, the number of new cases, which is running at around 400,000 at this point in time, they need to start tapering down. And then you need to see a much faster pace of vaccination. And then you need to see economy being reopened. At this point in time, the largest provinces in the country are reimposing lockdowns to control the spread of the virus. And by some measure, the economic activity levels are now dipped back to 10-15% below the pre-pandemic levels, which is not good for growth. Structurally, though, India remains a preferred play given the demographic strengths, but they need to do a lot better job than has been done over the past month or two in terms of controlling the spread of the virus.